Hello, this is Chad Carnes, Chief Market Strategist at ETFguide.com. Thanks for joining me today as I take you through market breadth and what it is and why it's important, and show you some of the indicators and charts that I use to follow the market breadth. On the screen you can see that I have outlined some definitions of breadth. And the top section shows that, to me, breadth is kind of like the barometer is to the weather. The barometer measures the pressure outside of the atmosphere. And when pressure is falling, quite often that means nastier weather is on its way. And when pressure is rising, it often means that nicer weather is on its way. So the breadth of a market can kind of tell you a similar thing, that when nicer markets are ahead, or maybe more nastier markets are ahead. But the official definition is that it relates to the number of issues participating in a move. And typically, technical analysts use breadth to tell, if a rally is suspect by if the number of advancing issues is diminishing. But if a decline is occurring and the number of declining issues is also diminishing, that could actually be a bullish sign. But the easiest way to kind of track breadth and look at breadth is just through the use of charts and comparing it over time to see what's going on. And I'll do that next. So right here is a busy chart, but I wanted to put it all on one page so that we can kind of move through it quickly. And I'll take you through the top section is the S&P 500, and then the bottom three are indicators that I like to use for breadth. But before we get to those, actually one of the most popular and accessible ways to measure breadth is through volume. And right now you can see on the chart that volume since 2012 has been in a steady decline, even as the market is going up. And now if we bring back our definition here, a rally is considered suspect if the number of advancing issues is diminishing as the rally develops. So volume suggests that less and less people are in the market or entering the market as the market rises, and that could be a sign that breadth is deteriorating, and has been since 2012. But one of the more popular for me indicators is the 52-week high indicator. And that's shown by this green section that I'm circling right now. A look at this shows that back in 2012, you kind of had just steady flat, and you can see the market was kind of churning up and down, and you had flat breadth basically. You had a couple times where you get a peak in breadth, and then you would get a decline in breadth. So right here, at the end of 2012, you can see the number of advancing issues was declining as the market was falling. And that's pretty typical in a downtrend. But you can see later on in 2013, in May, we saw the most new 52-week highs at around 200 out of 500 S&P companies. Since then, less and less stocks have been making 52-week highs. Even though the market is making new all-time highs, less companies are joining in those new highs. So this right here says that breadth is declining as the market is rising, and that is the definition of a suspect rally. A rally is considered suspect if the number of advancing issues is diminishing as the rally develops. This rally is developing and the number of advancing issues is diminishing. This is supported by the next section I have, which is the average stock's percentage of its 52-week price range. So that's a mouthful, but looking at the chart makes it maybe a little easier to understand. So back here in May, again, this ratio peaked out at 86%. This means that the average S&P 500 stock was trading at 86% of its 0 to 100% 52-week price range. That has been declining as well, now down below 75%. So the average stock today is 25% below its average range peak of the last 52 weeks. This shows that more and more stocks are farther and farther away from their 52-week highs since May. And finally, this last chart shows the percentage of stocks above their 200-day moving average. So typically, if a stock is above its 200-day moving average, it's in a rally. If it's below it, it's in a decline and or potentially a bear market. So back in May, also this ratio peaked at 94%, which means 94% of 500 stocks were all above their 200-day moving average. And since then, the same thing has been occurring. Only 85% at the January all-time high. At the recent March all-time high, only 83% of stocks were above their 200-day moving average. So All three of these and volume are showing that the market is rising, but the number of issues participating and the amount that they're participating in is declining, and this puts the market at risk of a top. What would make the conditions improve? Well, if breadth broke out along with a market rally, that would reverse the trend of declining breadth and show that the market was a lot stronger on that rally than it has been over the last half year to a year. But if this trend continues, as I mentioned earlier, this is a warning that less and less people are interested and less companies are participating in the stock market rally, and suggests that eventually most of these gains since May will likely be given back in the markets, which suggests a downside of in the 1600s in the near term. Thanks for joining me today, and please check out some of our other videos at ETFguide.com. We're also on Twitter, where you can follow us at ETFguide, and we also offer a monthly newsletter, ETF Picks, and I do a few times a week technical forecasts for our subscribers. Thanks again.